part 2 of the A through Z series. If you guys haven't watched the previous video, it's going to be all about your expectation coming into trading, guys, because this is an A through Z series on those of you who are at any level in your trading experience to get to profitability and achieve success, right? You guys will all benefit from this series. By the way, guys, you guys fucking with the new light setup back here? I got to get some decorations. I might make my background darker, like a black wall, or add some decoration behind. Get a nice Oro Trades logo. But we'll see, you guys will see that in the next coming few videos. But for now, this video specifically, we covered expectations first. And in this video, we're going to be covering getting started with futures. Knowing what is futures, how do they work, why you should be trading futures over any other platform or any other market, where especially when you're just getting into trading, how are we going to make money trading futures, and overall just how does futures work? What is this? Many of you guys have not heard of futures before, so we're going to be diving into what it is, how does it work, and breaking it down. So, what is futures? Futures is just another market you can trade. Imagine we have stocks, options, crypto, forex, and futures is just another market you could trade. For example, if we're trading crude oil futures, let's use that example. All you're doing is whatever price you're buying that specific asset that you're trading, you're saying, I'm going to buy this asset at a future date at X price. And that X price is the price you are buying at the moment when you press buy. Okay, and at a later date, at an expiration date, someone will give you the oil in return, sell you the oil for the price you said you're going to buy oil at a future price. That is generally how futures works, but you're not going to be trading oil with some other guy. We're not trading the actual asset and exchanging the tangible object. We are just making money off of micro price movements on the market. Like, we're profiting off of price movements on the chart. We're not actually buying and selling oil as a whole over like the months and months and months. We're just taking advantage of price movements intraday and making a profit off the candlesticks and price changes. Okay, so treat it as if it's a regular chart and you're making money from buying and selling. That's how you're gonna imagine this. So next thing we're gonna be going over, now we kind of broke down what is futures and a little bit of how it works. We're gonna explain why futures is better than other markets. So when we compare futures to stocks, a lot of you guys may know you can't make a lot of money with stocks unless you have a lot of money, right? You need to be able to have a large amount of capital to actually make money trading shares. But with futures, you get the leverage to be able to make a lot of money with only having a small amount of capital. And we'll break down how that works in later in this video. Towards then, I'll explain to you how you're able to access that leverage and make a lot of money with a small amount of capital. All right, now comparing to options. Now, options do give you that leverage, but what other thing comes with options? If you guys don't know, we have Greeks. Greeks make options a little more complicated, especially for those who are just getting into the markets, because you have to worry about things that affect the amount of money you're going to be making, the contract pricing. The amount of money you're going to make or lose is dependent off of multiple things, not just a single price and a single movement. You have Greeks like theta and delta and gamma that change the way your contract will be priced due to time and a bunch of other complicated stuff. That's why I tell beginners, avoid options and get into futures. Even experienced traders like me, I started with options, but now I'm going into futures because it's way more simple and it's easier to learn than other markets as a whole. Right, so it's overall my favorite one. Now, comparing it to crypto, yeah, you can make crypto money with crypto long term. Right, it's good for kind of long-term investing and betting things will go up. But the beauty with futures is you can make money when the markets go up and down. And the other benefit that comes with futures is that you get to trade. You also get to trade crypto futures. For example, a lot of brokers allow you to trade Bitcoin futures or Ethereum futures, right? It gives you the leverage to be able to make money off of small movements within the Bitcoin and Ethereum price. So you have that leverage to make money, a lot of money from the small price movements. Okay, and if you guys don't know what leverage is, it's just that aspect where you can make a lot of money off of small price movements, right? So comparing it now to Forex, the main difference between Forex and futures is that with futures, you're getting data from a regulated centralized exchange for the most part, right? Along with that, you're also getting typically a lot better spread, meaning the place where you execute at, the bid and ask spread, which we'll cover more in the terminologies in the future videos. The bid and ask spread is tighter, and typically you get filled at a better price when you trade futures compared to Forex. Okay. And you can also look at the commissions for some of the brokers. And you also, like I said earlier, I think I mentioned this, you get reliable and accurate, transparent data directly from the exchange itself, not from liquidity pools, which is what most Forex brokers use, because most of them are actually offshore. And the regulated ones, the ones that are actually regulated and give you legitimate, transparent data, they don't typically give you as good of a fill and tight spread as you do get with futures. That's why I recommend futures over all of them. Okay, guys? So, moving on, now that we've covered a little bit about futures, how it works, what it is, and why it's better than the other markets, we're going to discuss about how we're actually going to be making money trading futures, because that's what you guys are here for. You guys are not here about me to yap about some stuff about futures. You're here for me to yap about how you're going to make money with futures. So let's get to that. But first, we need to break down like that other stuff. So let's break down how we're actually going to make money trading futures. So in order to be able to make money with trading futures, you need to understand how you're going to actually profit and how you're going to lose money trading the futures. Contract sizing, how much you have to enter with, how you're going to trade, and how much, all that stuff is very important. Position sizing, risk management, whatnot. That's all for a separate video. But now I'm just going to explain to you how we're going to make money and how futures works. So with every futures name, you don't make, it's not like shares where you buy one share, price goes up $1, you're going to make $1. No, that's not how it works. You have leverage. For every name, we're going to look at specifically the NASDAQ 100 futures, okay? But for every single asset or thing that you're going to trade for the futures market, there is a set number of dollars that you're going to make or lose for every point move on that specific asset or whatever you're trading. So if you look at the NASDAQ, which is just the NQ, the NASDAQ 100 futures, right? If you guys are familiar with the S&P 500, the symbol for that is going to be the ES. This is the S&P 500 futures market, okay? But we're going to be specifically looking at the NQ right now. I'll give you guys some examples of the ES to compare. But I mainly trade the NQ, so we're going to be breaking down how the NQ works. So with the NQ, what I was explaining earlier, for every point or dollar move on the specific asset you're trading, which is NQ in this case, you're going to make or lose $20. So what is a point? How does this all work? Let's go over it. Let's say NQ is at $15,000, okay? NQ sitting at 15,000 price. 1 point is equivalent to one change in this digit, in this slot. So if this goes to 15,001, that is a 1 point change. It increased by 1 point. I should have wrote this down here and this one above it. It's a little weird with this one under, but this increased by $1. You can imagine like that, but we call this point. So the NASDAQ or the NQ went up by 1 point here. Went from 0 to 1, okay? Now, if you had a buy order at this price when NASDAQ was here at 15,000 and you held it and you sold it over here when NASDAQ went up to 15,001, you would have been up $20 if you entered with one contract, okay? Because the way the NQ works is that you make or lose $20. This is a plus or minus, by the way. It just means you gain or lose $20 per point, PT. Okay, so for every point move, let's get rid of all this. Let's actually move this down here. If the NQ went up to 15,010 points, it went up by 10 points basically, so plus 10. We know that the NQ, you make or lose $20 for every single point. So if the NQ moves up by 10 points, how much you're going to be profiting? If you bought here and sold here, how much you're going to be profiting? All right, do the math. All right, real quick. If we do the math, 10 points times $20 per point gives us $200. So you're going to be making $200 for every contract. By the way, this $20 can be multiplied based on the number of contracts you enter with. So you make or lose $20 per point. Alrighty, here per point. With one. Let's write that better. con. Con just means contract. Okay, so for 1 point, which was this, change it right here, you make or lose $20 with one contract. So we went up by 10 points. We made $20 for $20 per point. That's $200 gain right there if we bought here and sold here. Now the same goes, the same goes for the opposite. If the NASDAQ, let's get the pen tool. If the NASDAQ went down to 14,000, let's say 50, that is a drop of 50 points, which honestly isn't uncommon to see because you can see the NASDAQ gain or drop a few hundred points per day, like on average, which is a lot of points. So it's a very volatile market and you can make a lot of money. There's a lot of liquidity in it as well. So it's volatile and has a decent amount of liquidity. So it's enough action to be able to make money almost every single day. So the NASDAQ dropped 50 points, okay? And we said we make or lose $20 per point with one contract. So we do this times 20, okay? What do we get here? 5 times 2, that's 10. Then we add 2 zeros, that's 1,000. So we're going to be down $1,000. Let's put a negative sign after, actually. Negative $1,000 if we bought here and sold here. Now, a key thing I want to let you guys know, if you guys aren't aware, with futures, you can also make money when price goes down. You don't just make money when price goes up, you also make money when price goes down. All right, now how does that work? Because with futures, you have the ability to short and go long. What that means is going long means you're playing and betting that price will go up, and shorting means you're betting that price is going to go down. Okay? You execute a sell order. If you think price is going down, this will put you in a short position where you will make money as the price goes down. For example, in this case, if we executed a sell order or a short order when price was at 15,000 and we closed our position at 14,000. Oh, sorry, guys. I just realized I messed up on my math. That's actually crazy. Coming for a computer science major, that is actually sad. 14,950. Okay, that makes more sense. Hopefully you guys realize that I finally changed it. Okay, so let's say you put a sell order when price was at 15K and it dropped 50 points to 14,950. Now, since we did a sell order and not a buy order, we did a sell order, we were making money when price goes down. So it's the same thing as if I told you when you make money when you buy, meaning you do the same thing how you make or lose $20 per point with one contract, but instead of making $20 per point when it goes up, you make $20 per point when it goes down, and you lose $20 per point when it goes up. Okay, so it's just flipped around. Just imagine it's the same as a buy order, but just flipped around. Okay, that's how I like to visualize it. So we would be up $1,000 in this case if we did a sell order, okay, instead of a buy order. Okay, and if we did a buy order at this price, we'd be down $1,000. All right, very, very simple. All you have to see, it's not like options where you have to worry about the Greeks. Oh, you have theta potentially affecting the price. You have to worry about delta and gamma. No, if you think price is going up, you execute a buy order. And if you think price is going down, you execute a sell order. Okay, that's pretty much what covers. That pretty much covers exactly how you're going to make money with futures. Now, if you want to talk about multiple contracts, okay, multiple contracts and contract sizing, I'll explain that right now. It's very, very simple. All you need to know is that the number of contracts you enter with multiply the amount of money you're going to make or lose. So if we're making $20 per point with one contract, if we have 2 contracts, we're going to be making or losing double this. So times 2, that's $40 per point. So instead, if we entered this position, this long position, let's say we executed a buy order here, right? We lost $1,000 if we had one contract, but if we entered with 2 contracts at this price, we would be down $2,000. Why? Because this is with one contract, but if you do 2 contracts instead, you multiply this number by 2, which gives us a loss of $2,000. Okay, now you guys might be saying that's a lot of money. What if I don't even want to lose this much with one contract? What if I want to be able to make or lose less? Because the thing with futures is you can't trade with a number of contracts that isn't a whole number. So you can trade with 1, 2, 3, 5, 10, 12. You can't trade with 1.5, 1.3, 2.9, any of that stuff. You need only whole numbers, okay? That's why the micros exist, okay? The NQ is called it's just the Nasdaq futures, but I forgot. I know the ES is called the E-mini futures. Okay, these are called minis. Typically, you'll hear minis whenever they're referring to futures. Okay, this is representing the S&P 500, the SPY. But we also have this thing called the micros, which is, as it's in the name, micro version of the futures market you're trading. So with the NQ, we also have the micro NQ, which is just MNQ. That's the symbols for the actual for the actual asset or the actual underlying. It's MNQ. That's the ticker. That's the symbol for it. So all this means is, as it's in the name, micro, meaning instead of gaining or losing $20 per point, you are now, everything is divided by 10. You are making or losing $2 per point. Just $2, not 20. Okay, it's everything divided by 10. So for every point move, you are going to, for every point move, you make or lose $2. Let's just write it out right here. I cannot type for the life of me. Okay, $2 per point with one contract. Now you guys can see the flexibility you have, where if you don't want to be able to have crazy amount of leverage, you can have that with the micro NQ, right? The way I like to imagine it is the micro NQ is the same as the NQ divided by 10. So if we entered the NQ with one contract, if we were to trade this with the same size on the micro NQ, that would be just like us trading with 0.1 contract sizing. We can't do that with NQ, but I'm just giving you guys an example. If you want to visualize it with the NQ, if we were to enter with 0.1 cons, sorry, I'm doing that wrong. With 10 cons of the NQ, we would make this much of the micro NQ if we enter with 10 cons of the micro NQ. Okay? So that's all there is to the micros. It's the same thing. Price moves the exact same pretty much. There's nothing complex about them. It's just allowing you to have less leverage and be able to make or lose less money, just in case if you don't want to, if you have a pretty large trade where you take advantage of larger price movements, maybe 50 points, you don't want to be probably making or losing $1,000 or a few $1,000s per trade. That's kind of a lot of money, especially when you're just starting out. So you want to go with the micros and get used to kind of building yourself up by starting with small. Maybe you do with a few micro contracts, whereas let's say you caught a 10-point move, 10 points with 3 cons. Okay, let's say you bought, price moved up by 10 points. Why can't I not move this? Price moved up by 10 points. So what are you going to do? You're going to do $2 multiplied by 10 points, which is going to give you 20. Now, with one contract, you'd be green $20, but you have 3 contracts now. So you multiply that by 3, and you'd be green $60 plus 60 kachings, schmickles. All right. That's pretty much micro NQ futures. That pretty much sums up everything about trading futures, if I can remember topics. Yeah. Okay. So this is pretty much how it works. There is also margin involved in futures, but you guys won't have to worry about this unless you're going to be trading a live account, because most of you guys are going to go with the approach of a funded account, which I think I'll hold that off for the next video. Okay, that's going to be explained more in the next video, which is going to be setting up your account, getting started with a demo account, the best platforms to use, the best charting platforms, the best trading platforms, the best brokers, what I would recommend for demo trading, how to approach it, how to get started with a prop firm and transition to that. But right now, we're going to be explaining, I'm just going to finally explain you the last concept, which is going to be margin, right? It's essential to know because you're going to have to understand it at some point because it's a big factor in futures, but you don't really need to worry about it when you're trading, when you're trading prop firms or trading a demo account, okay? And you guys are most likely going to go with the prop firm approach, but enough about that. I'm not going to explain that in this video. We're going to be covering that more in the next one, okay? So, what is margin? Margin is not the same as it is in stocks and options. It's a little different in futures, okay? All it is a deposit you give to the broker to give you access to be able to trade a certain amount of contracts on the NQ. Okay, big definition. What does all that mean? Let's break it down right now. So, imagine you're working with a broker. All brokers have a minimum number of margin required for you to be able to trade with a certain amount of contracts. Let's say one contract for now. If you want to be able to trade the MNQ, let's just erase this over here just so you don't get confused. If you want to be able to trade with the MNQ, right, so you're losing $22 per point, you have to deposit a minimum of $50 into your brokerage account. Okay, this is the minimum margin you need to be able to trade futures, right? Just imagine margin as not like stocks or options, but as a deposit you give to your broker for you to be able to trade with one contract of the micro NQ, the MNQ. Okay, so $50 is how much you need to deposit at the minimum, but of course we need to leave room for error because we're not just expecting price to go immediately to our take profit at all times. Sometimes we might lose a trade, sometimes we might go in drawdown. So we have to deposit at least, I would say, a few hundred more, so maybe $300 to give yourself some wiggle room, especially when you're just starting out because you're not going to turn profitable immediately. My goal is to get you guys to profitability as fast as possible, but that's not going to be the case right away when you take your first few trades, okay? So when you deposit money in your broker, you're going to want to do a little more than this amount of money per day. This is your intraday margin, meaning if you're going to be trading, buying and selling within the day, you need to have a minimum of this much money. There is a larger amount of money required if you're going to swing trade, which is meaning you're going to be holding your position across multiple days. You're going to need a little bit more money. There's a higher minimum requirement here. But specifically, if you're going to be trading, buying and selling intraday just means like in the same day, then $50 is the minimum you need. But I would recommend going further and adding a few $100 because you need to leave room for that error in case you're going to go red or lose a trade and whatnot, to leave room for drawdown. Okay, so $50 and you could trade with one contract, which means you can make or lose $2 per point. Okay, so if you catch a 10-point trade, like we mentioned earlier, $2 per point, that's a $20 trade. You made $20 profit on your trade, okay? Now, if you want to trade with 10 contracts or maybe, let's say, 5 contracts, all you have to do is multiply this minimum margin by the number of contracts you want to trade. So multiply this by 5. What do we get? We get $250 minimum needed if we want to trade a minimum of 5 cons. 5 con minimum. Okay? We need a minimum of 250 in our account. And again, we need to leave room for error and drawdown. So I would say going as far as adding another few hundred, like maybe even just going up to 500, just so you have that drawdown, that room. Because if your account or the amount of money in your account falls below that minimum margin, the broker is going to let you know and it's going to liquidate all your positions. It's going to exit you out of all your position, and it's going to tell you to add money to your account to bring yourself back up to that minimum margin. Okay, so you want to be careful. That's why I say have at least some buffer and don't just enter the minimum when you're going to be trading with this. But by the way, guys, you guys don't really need to worry about this. I'm just explaining the concept for now because we're going to be trading on demo when we're first getting started. And I'm going to set you guys up to transition to prop firms, which is going to be a lot more beneficial to you guys. Okay, I don't want to talk too much about that. I want to save that content for the next video and go way more in depth. So don't worry about that. I'm just explaining how margin works. So just try to understand the concept of margin and not about like how much money you're going to be making or tomorrow, how you can get started with margin right away. But yeah, same goes for the NQ. You're going to need $500 to be able to trade with one contract of the NQ minimum. Why 500? If we look at the micro NQ, I said you need a minimum of $50 to be able to trade with one con. Okay, with one con. Okay, and the micro NQ, I told you, is the same as the NQ, just divided by 10. So if you wanted to trade one NQ, that's the same as trading 10 micro NQ contracts. Okay, so if you wanted to trade 10 micro NQ contracts, so instead of trading with 5 cons minimum, let's say we had 10 cons, that's going to be 50 times 10, which is going to be $500, which is equivalent to one NQ. Okay, now you guys can see the mathing, all right? So you need 500 minimum to trade with one NQ, and again, I would require a buffer of at least a few hundred, maybe like up to 1,000, because now you're trading the big boy contracts, which is you're making $20 per point. I would say like leave some buffer room. But now, that's pretty much it for margin. I think I covered pretty much everything you need to know about getting into futures, about the fundamentals of futures, how it works, what it is, why it's better, how we're going to make money from this. If you guys have any questions about these concepts, let me know down in the in the comment section about any suggestions or anything I didn't go over as in depth, and I'll make a separate video on it if I see a lot of people really want me to explain that again. Or I'll reply to your comment about it if it's a very simple concept I can explain that doesn't require a whole video explanation. Okay, and if you guys have any suggestions on content ideas for the actual series, let me know down below as well. This is going to wrap up this current video. Next video is going to be covering, let's see. Yeah, getting started with setting up your demo account, what broker to use, the charting platforms, how to actually start trading and how to literally place your trades, how to approach trading as a whole, your demo trading, and transitioning to prop firms, explaining that part. So it's going to be pretty in-depth video. These videos are not light. I highly recommend you pay attention. If you have to, take notes, but I would say try to eliminate all distractions, right? And for me, I never really benefited from taking notes unless it was something I really, really wanted to look back to later. I think the best way you guys could approach this is just sit there and watch my video. Stay zoned in and like don't let any distractions cause you to lose focus and shift into I'm gonna watch 5 minutes. Oh, let me go on my phone. Scroll. It's getting a little bit boring. No, you need to stay focused and actually watch the entire video and learn the stuff I'm teaching you, because this is the foundation, is the fundamental knowledge you need to know to set yourself up to be able to trade futures. Right? You can't just keep getting distracted, whatever. You need to stay focused to remember all the things you're watching. Okay? Stay focused, watch the entire series, and learn. That's how you're going to be able to understand and engrave all the knowledge into your brain when you're focused and actually dedicated and wanting to learn. No half-assing bullshit. Okay? That's what I want to see from you guys. All right? Again, any comment, any suggestions, any questions you have, let me know down in the comments. I'll get to it whenever I can. I'll see you guys in the next video. Take care, guys.